Welcome to The Explainer. Today, we're going to skip the hype, skip all the speculation. We're going to explore an argument that says Bitcoin's path to a multi-million-dollar valuation isn't some market fantasy, it's actually just a matter of simple, unchangeable math. Let's break down the numbers.
All right, let's just jump right in with this pretty bold claim from our source. The core idea here isn't that some crazy bull market is going to push Bitcoin to these heights. Nope. The argument is that this is the logical, almost inevitable outcome of a mathematical process that is already well underway. Okay, so how on earth do you even start to make a case for a multi-million-dollar price tag? Well, the argument begins with a massive problem, the global debt spiral. To really get why Bitcoin is presented as the solution, we first need to understand the sheer scale of the problem that's baked right into our global financial system. Let that number sink in for a second. $123 trillion. That's the global M2 money supply. So think of it as all the easily accessible money in the world. Cash, what's in your checking and savings accounts. And what's absolutely nuts, according to the source, is that almost a quarter of it, $30 trillion, was created in just the last 4 years. And, all that money printing is tied directly to this number, a staggering $323 trillion in total global debt. The analysis we're looking at says this isn't just a big number, it's a mathematical trap. It makes repaying what we all owe in any traditional sense pretty much impossible. Yeah, this chart really hammers the point home. You can see global debt is sitting at more than 3 times the size of global GDP. To put it really simply, the world owes more than 3 times its entire annual economic output. I mean, it's like having a credit card bill that's triple your entire yearly salary. How do you ever pay that back? And this is where history gives us a clue. The source points out this pattern. Whenever a country's debt gets this high, the politically easy way out isn't to tighten the belt or default. Nope, it's to inflate the problem away by devaluing the very money that its citizens are holding. So, if the traditional system is in this, death spiral, what's the alternative? This is where the whole argument pivots. We move away from the world of politics and into the world of pure, unchangeable code. And this right here is the absolute core of the idea. Absolute scarcity. It's a concept that's pretty wild when you think about it. Bitcoin's supply is literally hard-coded. It doesn't matter if the price goes to $1 billion tomorrow, you cannot make more than 21 million coins. Ever. And look at this comparison, it just lays it all out so clearly. On one hand, you've got fiat currency. Governments can print as much as they want. Then you have gold, which is pretty good, but we're still digging more out of the ground every year. And then there's Bitcoin. Fixed supply. And the new supply rate, it's programmed to shrink. All of it enforced by code, not some committee in a boardroom. So, this shrinking supply thing, it's not random. It's a built-in mechanism called the halving. And you can see it right here on this timeline. Every 4 years, like clockwork, the amount of new Bitcoin getting created gets sliced in half. We just saw it happen in April 2024. We went from 900 new coins a day down to 450. And in 2028, boom, down to 225. It's completely predictable and totally unavoidable. So what does all this mean? Well, look at this chart. The vast, vast majority of all the Bitcoin that will ever exist is already out there. We're talking 95%. And when you remember that millions of those coins are probably lost forever, people forgot their passwords, lost hard drives, the actual supply you can buy is way, way smaller. And it's only getting tighter every single day. Okay, so you've got this shaky traditional system on one side and this super scarce mathematical asset on the other. So what happens when they collide? Well, that brings us to the catalyst, Wall Street's one-way valve. This is where the theory gets real fast. $57 billion. That's how much money has poured into the new U.S. spot Bitcoin ETFs since they launched in January 2024. Now, these aren't just regular investment funds. They're the thing that lets the big players, we're talking huge institutions, get in on the action easily. And get this, it's been the fastest, most successful ETF launch in history. This isn't just a few people buying in. This is the big money. And this slide, wow, this just shows you the insane imbalance. On the one side, you have the tiny sliver of new coins being mined each day, just 450. And on the other, you have this massive bar representing what the institutions have been buying on some days. It's been more than 20 times the new supply. I mean, the demand is just swallowing the new supply whole. And that's what our source calls a one-way valve. Think about it. You have this tsunami of demand hitting a brick wall of supply. The supply is inelastic. That's a fancy way of saying it can't stretch. It can't grow to meet the demand. So if the supply can't change, what's the only thing left that can? The price. Okay, so if all this math is playing out, what does it actually mean for you and me? That brings us to our last section, the preservation trade-off. And the source here is pretty clear. This isn't about giving you investment advice, but more about offering a new way to think about the financial world. So the source breaks it down into this four-part framework. First, it says to think of this as a defensive play. It's not just about getting rich, it's about protecting yourself from your currency losing value. Second, custody is a huge deal. You've heard the saying, not your keys, not your coins. It means holding it yourself, so you're not relying on a bank or an exchange that could fail. Third, the time horizon is everything. You got to think in decades and not get freaked out by the daily price swings. And finally, there's this idea that the window of opportunity might be closing as governments look at new forms of financial control. And really, it all boils down to this single, crucial choice presented in the source. You can choose nominal stability, meaning you hold something like cash or bonds where the number on your statement doesn't change much, but its actual buying power is quietly getting eaten away by inflation. Or you can choose purchasing power preservation. That means holding an asset that's volatile day to day, but is designed to hold its value over the long haul. The argument is, in today's world, you just can't have both. So let's wrap this all up. The argument we've walked through today isn't about hype or feelings or bull market predictions. It's about a collision of two completely opposite mathematical systems. You've got one system built on unpayable debt and infinite money printing, and you've got another built on absolute, provable, unchangeable scarcity. The whole point of the analysis is that the math itself seems to be pointing to a final destination. The only real question left is, when will that financial equation finally solve itself?